us what, having judged what you saw in the economic numbers this week and what the Fed said in their statement, where do you think we're going to be now with interest rates?
I think the Fed is going to have one of the loosest tightening cycles we've ever seen. It's keeping its start uncertain. I think it's September, but the Fed is keeping all its options on the table, including June. I think it's going to be September, though. Secondly, the path is going to be extremely shallow. And thirdly, the destination is going to be lower than what we've seen in the past. So we are looking at the loosest tightening cycle in the modern history of the Federal Reserve.
So this will be the loosest tightening cycles, that at least the beginning of a cycle that we're going to see for the Fed. So what does that mean then for Treasuries? What does that mean for the equity markets?
So first, I think it speaks to a U.S. economy that's not as bad as the first quarter GDP number suggests. And the GM numbers, yesterday's jobs numbers were strong, be it jobless claims or be it employment costs. So I think the U.S. economy is not as bad as a lot of people think right now. In terms of what happens to interest rates in the U.S., you've got to ask about Europe. It is Europe that is going to determine our interest rates further out the curve. And as long as Europe remains depressed, as long as the ECB has its foot all the way down on the stimulus pedal, the interest rates there are not going to go up in a huge way. So I see our interest rates are going to be relatively well behaved, even when the Fed moves.
Mohamed, I'm glad you brought up Europe. What happened to the Bund this week? Last week we thought the 10-year was going to hit 0. Now the 10-year is back up at a 0.2 from 0.05. Obviously, Bill Gross, your former colleague, and Jeff Gundlach came out and saying everyone's crazy, they need to short German debt. But the move is extraordinary. What drove it?
I think people woke up to the fact that there's a limit to how low you can take interest rates before you get a buyer's strike. I'm stunned that there are people willing to buy so much fixed income at negative nominal yields. Look, I understand the argument they can go more negative, but give me a break. I mean, there's a limit to that. So I think what you got is a wake-up call that, yes, you can have ultra-low yields for a while, but they shouldn't be too low and they shouldn't go too negative. At one point, up to the 9-year point of the German curve was negative. And I think people just woke up and there's been a bit of a buyer's strike.
It's wild. How about the move in the euro this week? I think we're back up to 112, 113. We did, though, get some better than expected data, in particular the money supply numbers. Does it look to you like banks in Europe are actually lending again?
So remember, the euro is a relative price.
Yeah.
So it measures two things. What happened is you had lower expectations of the U.S. and higher expectations of European growth, which also realigned a little bit the relativities of monetary policy. I don't think that's going to last, but remember, it's a relative price, so it moves when either of these two things moved, and what's happened in the last few weeks is both of these things have moved.
You know, Mohamed, everyone keeps wondering when's the next crisis going to happen? What's the next crisis, right? So I keep getting warned by bond traders that there's a liquidity crisis that is brewing in the fixed income markets. And it was interesting because in your last column, you kind of alluded to that. And I want to just read a quote from that column. You said, due to both regulatory and market forces, the risk absorption capabilities of broker-dealers are likely to fall short of what end investors believe are necessary and have been used to. Essentially, there isn't the kind of liquidity in the fixed income markets that you might be led to believe, right?
That's absolutely right. And it's the most underappreciated risk right now.
Yes.
Why is this happening? There's been a fundamental structural change. In the old days, the broker-dealers were big relative to the end users, who were small. Now, the broker-dealers have been shrunk, and the end users have gotten very large. So when the paradigm changes and the end users want to reposition themselves, there isn't enough risk absorption. So what do you get? Very sharp price movements and market dysfunction. And I've been worried about this. I've called it the illusion, or maybe better, the delusion of liquidity.
Yeah.
But it's not just me. Jamie Dimon wrote about it in his letter. We've had and investors worry about it, and we've had regulators worry about it, but nothing is being done about it. So that's something that investors have to realize. And the answer is make sure you're getting compensated for liquidity, for the liquidity risk you're taking.
Mohamed, a quick question about the New York Jets. You have unique perspective because you spend time in Southern California and you're a Jets fan. What do you think of their #1 pick, Leonard Williams?
So I think it's a great pick on the defensive line. I worry less about the Jets' defense, though, than I worry about the offense. So it's a great pick. It's going to make the defense, once again, the thing that's going to carry this team. But we need a bit of offense. We need to be able to score a little bit.
Right. It's what Rex Ryan did, was he overstacked the defense in the draft. It's kind of the same old thing.
Yeah, it's what I call active inertia. You know you want to do something differently, but you end up doing more of the same. And the Jets, for quite a while now, have really been concentrating on getting their defense. And the defense makes people like me really proud.
Yes.
It's just that we also need to score some points.
Well, I'm predicting them to go to the Super Bowl this year, so.
Oh, leave it.
Oh, I'll take the other side of that.
Leave it to Bob to ask the most important question and topic of the day.